Hey guys, so this is a quick video to explain one of the ratios I use the most with especially high growth companies in order to explain some of the revenue dynamics that they have. And it's called the external capital ratio. And essentially what it says is, what are the sources of your growth capital going to be as you try to grow over the next couple of years? So if you are a SaaS startup, a scale up, a growth company, or wherever you are in your journey, you are going to get growth capital from two sources. One is going to be the revenue from your customers. So you sell them a product, they buy it, they give you cash. Great. You can take that cash, reinvest it into new sales, development, and so forth into your business. Also, you can take that business as a whole and show it to an investor, venture capitalist, or someone else and say, well, look at this business, it's growing really well. If you give us growth capital externally into the business, we can grow it faster and you get a piece of the pie. Okay, so that is sort of the funding game ABC, right? Now, the interesting part here becomes, well, how many dollars of internal customer driven revenue do you have versus how many external venture capital dollars do you have to grow with? And that is what the external capital ratio lays out. And it breaks down like this. So let's say that you have $1 of ARR, right? So you have $1 of revenue with a customer. Let's say you then take that dollar, and in the current capital market, now this video is November 22, you might get a VC multiple of 15, it might be 25. It's last year in 21, late 21 Q4, it might have been 50, depending a little bit on on what kind of business you had. But let's just run with the example of 15 here. So let's say that you take your $1 of ARR and say, how much is that worth to you? And then your venture capitalist is going to say, well, we're going to multiply that by 15, and then you're going to get a pre-money valuation on that $1 of ARR for $15. So we're going to value your company at $15. And then we're going to expand the equity base with another 20%. So that means that the $15 is going to give you $3 of equity here. So you're going to raise $3 of capital, and you're going to do that every 1.5 years. Let's say 18 months runway, and then you're going to raise again, and so forth. So that means that for every year, you have to spread those $3 out over a 1.5 years. So that means for every full year, you're going to have $2. But that's also the year where you get the ARR of $1. So that means that the ratio of external capital, venture capital dollar to ARR 1, so that's customer-driven revenue 1, so that is the external capital ratio of 2. So that basically means that for every $1 of revenue that you have, you're going to get $2 of venture capital revenue as well. So $3 total per year to grow for. One of them is going to be from customers, 2 are going to be from venture capitalists. Okay, great. So let's play around with this and say, what happened back in 21 or Q1 of 22 when multiples were way higher? Let's say that you had a multiple of 50. Now the external capital ratio jumps to 6.7. So that means that you're going to have $6.7 of venture capital revenue for every $1 of customer revenue as growth capital. Well, what does that do? That means that you start to have a lot of the decision-making changes. If you have an opportunity to go to your customer and say, well, you're going to give the first 3 months off. That's fine, because I'm still going to have the run rate ARR. I'm going to raise the majority of the cash from the venture capitalist. So I actually don't need the customer's money that much as long as I get to book it as ARR, right? So, well, do you want to pay annually upfront or over the course of a full year? Doesn't matter, because I'm going to get most of the money from a venture capitalist anyways, right? But in today's market, where you have a multiple of, let's say, 15 or 20, and the multiple sits between 2 and 3, actually the customer revenue becomes much more important. And that is why all these small decisions regarding customer cash flow, customer discounts, customer revenue becomes much more important, because the external capital ratio in today's market is a lot lower. So that is the market condition. If you then take that to the higher, let's say, stages of growth, let's say Series B plus, C plus, something like that, where the VC multiple is already lower. So let's say we're having, let's say, a multiple of 10x. Let's just do 10x, maybe it's 12x, but something like that. And let's say that the round equity might be somewhat let's say, higher as well, then we're there. And that is actually because the round equity is higher here because we want the external capital ratio to remain high. If we had the same round equity as before, the external capital ratio would be very, very low, and we would be so focused on generating cash from customers that we actually wouldn't be enough growth focused for the kind of venture capitalists that we attract here. So that is why they actually want to buy large pieces of the pie at this point to say, well, we want to incentivize the growth. So the external capital ratio is one of the more important metrics, determines a lot of these sort of cash flow, revenue making decisions that you have within customers, also in terms of service revenue and so forth. So I use it a lot. It doesn't give, it gives sort of a rule of thumb of where you are. Do you need to sort of focus more on the customer sides? Are we at a low external capital? So bootstrap companies has, zero, right? No external capital, right? So they have to get all of their revenue from their customers. So they want to get revenue fast. They want to have all the incremental revenue. They want to have customers pay for onboarding. They want to have, upfront payments and so forth. So you can say that the closer you get to zero, the more you have to operate like a bootstrap company. And the closer you get to, I don't know, an external capital ratio of, I think the largest external capital ratio I've seen is raising something like 15% on a VC multiple of 100 in a Series B. So there you have it. It's I think they had a bit more runway, but so above 5, the external capital ratio basically means free money, right? From a psychological standpoint, that's how it feels. It feels like your customers actually does not matter in terms of bringing cash into the business. In a relative sense, all of the capital is going to come from outside and not from the flow of your customers. Whenever you get below 2.5, 3, you tend to see founders focus a lot more on revenue from customers. And I think in today's market where you have these VC multiples of 15 and you have round times where you say, well, we need to stretch the runway to 2 years plus, you get external capital ratios of around 1. And that is actually really healthy for building solid businesses with good cash flows. So calculate what yours is and what you're expecting it to be in the next couple of years. And maybe that can be sort of a benchmark to guide your decision making. All right. Cheers, guys.